Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 31st, 2016. It's a little after 9:30 the market Eastern time. The market's just opened, and wanted to go over the charts real quick. That'll be a quick overview. There's not much that I haven't already covered. We did see there were a few potentially technically significant things that happened yesterday, and that's why I'll do this video here. Before I get into the charts, which again will be a quick overview, I just wanted to mention a couple housekeeping items. My analysis will continue to be light, at least what I'm putting up. I'll be in and out of the trading room today. I do plan, hopefully, before the weekend to clean up the trade ideas, and I also plan to post a little more information on the subscription service, which will actually, I'm going to roll that back to Sunday. I'm leaving town tomorrow for vacation. Kids are on spring break, and my wife had booked a 3-day trip. We're going out of town tomorrow, so I figured it'd be better to just hold off until Sunday. So everyone will continue to have free access up through the weekend, and I will put out a little more information on the subscription service later today, as well as get those vouchers out to everybody that's donated on the site. I'll try to get those out by the end of today. All right. With that being said, let's just take a look at the charts. What happened yesterday? Schooner in the trading room had pointed out a nice observation we have on the Qs. Again, my primary focus lately has been and remains on the QQQ as, pretty much what I refer to as the leading index. And what we had here is this potential shooting star. If you look at this candlestick here, we had a gap up. Shooting star almost put in a gravestone doji, but we didn't close at the bottom of that. But either way, this is a potentially bearish candlestick. These can sometimes mark tops. Now, what I find most significant about that is look where it occurred. If you recall from the recent videos, and really I've been harping on this since goodness, before it even broke down, this whole trading range. There's that trading range from late 2015. We gapped down. We had that reaction right here to back test it. This candlestick here from below. And I haven't modified this line at all. This is the same video I did yesterday. Look how well we hammered off the top of that level. We kissed the top of that, back tested it, and then put in that doji. Now, really how we close the day will be important. Anything can happen. One possibility would be quite bearish is if we take out yesterday's highs and then close below yesterday's lows. That would put a nice bearish engulfing candlestick. This candlestick here today's would engulf. But most importantly is how do we close today? Now we can close within that range, and if so, there's still a potential for an island cluster top, which means you have a few candlesticks here above this level here, above yesterday's, I should say not yesterday's, Tuesday's highs, and that's one possibility. But if we close below that, that would be the first bearish sign. When you have a potential topping stick like this, what you're looking for is follow up to the downside. So where we close today will have significance. We've already now kissed and back tested that level for which weeks I said was a possibility, and we're getting to my upper echelon, if you will, or threshold, I should say, of where this rally should stop, and that is the big level there. Now, I mentioned in the trading room, had I not already been short, my plan was I started scaling in a little early, and I knew that might be the case, but that, I didn't also, at the time, I didn't want to miss a sudden reversal, and my plan was, which I did, is to add exposure, leave some dry powder, but only add if and when on weakness at this point. I'm not going to continue to add at this point. With that being said, had I not done that, if I were in mostly all cash right now, I would be shorting fairly aggressive right here. I think that's a very objective entry. Whether this market goes on to make new highs or not, that's yet to be seen. However, objective because look at this support shelf. I'm sorry, which former support shelf, now resistance. So you're shorting at resistance, and a stop would be right above, I would say about 1 to 2% above on a daily close, ideally above the top of that gap. I'm referring to this candlestick here from December 31st, where the lows were. So, to quantify that, I'll have to flip to another screen real quick. We're talking, I'm grabbing the measuring tool, I'm moving up if you follow the horizontal line over. what is that, 1.5%? So 1.55% downside. Well, let's take it up above there. So you add another percent or two. I would say 1% should be plenty. We have no business closing a percent above that level. So call it, if you want, 2.5% downside for what could be, double digits on the downside for a swing trade or trend trade, because as I mentioned, I've already made the case on the longer term chart, so I won't spend any more time doing that today. All right, so that's that. So that's what I'm looking for. Let's see how we follow up today and tomorrow, and of course into next week. So, this could do one of many things. We could reverse from here. We might chop around sideways for a couple days, or we could get into that gap. And if we get up into that gap, there's a good shot that we may backfill it. We may just peek right on through there, but chances are if we get up in there maybe a quarter, a third of the way through into this, I'm talking between the red line and the white line, then the odds are pretty good for a backfill. Gaps tend to be filled once they're entered from above or below. So that's that. That's the cues. And, like I said, the longer term, other time frames, a case has been made that it still looks bearish. Here's IWM, the other index that I'm focusing on, and personally short as far as broad markets go. Same story here. This is, I'll color this line a little bit better for you to see on the video. There's that gap, what I call a uber, or very significant gaps that really kicked off the whole big sell-off in starting on the first trading day of the year, January 4th. So look at that. Look at what we've done so far. We actually came right up to there, and you can see how we just kissed almost perfectly the top of that, the bottom of that gap, I should say. And I don't even have the line zeroed in exactly. Yeah, it's pretty close enough. So you can see that. And on top of that, you see these yellow dotted lines. If you look to the left, these are the Fibonacci retracement levels off this reaction high back here in what was that, June. So you look at gap and Fibonacci resistance, the 50% retracement from at least this leg down at that point. And I haven't done so, but sometimes I like to put up fib clusters. Here's another key, significant reaction high. I would probably change this color, but let's do that real quick and just take a look and see what we have here. Let's put a color that stands out. And now look at that. So we have the 61.8 fib off this reaction high right there. So we're just a hair above that. So that's what we call a fib cluster. These two line up perfectly, but these are close, and just something to look out for. So that's the story in a nutshell, is that you have the key resistance, the key indices, I should say, coming off a very strong but extended run. You can see the divergence already setting up here on the daily time frame. I've gone over the 60-minute charts quite a bit recently. Nothing's changed there. Here's the IWM. It's frustrating, no doubt, if you're short. My personal proxy was a TNA short to try to take advantage of any decay if we did get caught up in a sideways range, if this move did take longer to play out. So we've moved sideways to slightly higher, but with each new high, we made a lower low on the MACD, the RSI, my trend indicator histogram here, and so all that still points to a likely trend reversal. That's what these divergences show. So that's what I'm looking for. Let's see how the markets act around these gaps. And again, there is still that possibility of a backfill. The momentum is clearly up, and there's always a possibility for more than that. So if we get in the gaps and we fill the gaps, then that's where I'll be watching. How do we act on the top of those gaps? I'd really, I would think that a gap backfill will start to chip away at the bearish scenario, because a lot of these divergences have the potential to be burned through. So ideally, for the bearish case, we turn down now. And again, that's why I'm personally at this point not adding, because I don't want to, have too much exposure until I see some evidence of a reversal. I think that's if you're already short, that's the best thing to do. But again, if you're not short, it's certainly objective to short here at the bottom of those gaps and at those fib levels, with stops not far above, because you can easily quantify your downside risk, which is, like I said, minimal to the potential gains should the market reverse and roll over here. Okay, this has been Randy Finney with Right Side of the Chart, and as I said, I will follow up on any emails, trading room private messages at my earliest convenience. I'll still be working on some back-end issues, and like I said, I'll get a little more detail out on the membership information. Have a great trading day.